Hey everyone, me Kevin here. Bernie Madoff is known as a fraudster who orchestrated one of the largest Ponzi schemes in history with a fraud worth over $64.8 billion. Well, this week, an analyst compared Tesla to Bernie Madoff. In this video, I'm going to explain why they would do such a thing and what it means for Tesla stock. Quick reminder, if you're watching this on New Year's Eve, you could still take advantage of those amazing course programs linked down below, because remember, if you get some expenses rolling here New Year's Eve, you could still write them off. Obviously check with your CPA to make sure you can write them off, but assuming you could still write them off in 2020, which is nice because then you get to use those tax savings for an extra year to, well, go buy Tesla stock. Check those links out down below, but just make sure to use that holiday coupon, which you can also apply to the bundle offers. Link down below. All right, now Tesla. So Tesla has a big update coming in the next few days for us. We are expecting Tesla to beat Wall Street consensus delivery estimates of 176,000 deliveries in the fourth quarter. If Tesla beats this estimate by just 4,000 vehicles, Tesla will hit a milestone of delivering 500,000 vehicles in 2020, despite the pandemic. Now, this is a far cry from the 2.5 to 3.5 million vehicles we expect Tesla to deliver by 2023 and 2025 on an annual basis, depending, of course, on how quickly Tesla can ramp up their production at their gigafactories. But 500K is an exciting and round milestone. Unfortunately, according to Barrons, there's a dude over at GLJ Research, an analyst named Gordon Johnson, who has some really big questions. Gordon Johnson finds it odd that Tesla's profit margins keep going up despite the fact that Tesla keeps cutting the prices of their cars. Now, Barron's didn't break down the price cut history for me, but what I thought I would start by doing is realizing, hey, I bought a Tesla Model X for $95,000, the 7-seater, back in the day when I bought it at the end of 2017. Well, I went to Tesla.com over here and I realized their cheapest one is $79,000 now. Now, I am going to have to upgrade this to black. We'll go with the standard rims. And let's go ahead and get the 7-seat interior. Okay, let's jump on over to full self-driving. I had to pay for separately later, so that doesn't count. Anyway, we look at that after the fact, and okay, the purchase price is about $83,000. So, in other words, had I just waited 3 years to get my Tesla Model X, the price is now $11,500 cheaper than what I paid back in 2017. But that's back in 2017. Tesla actually ended up having 3 price cuts, or series of price cuts, just this year in 2020. Here in 2020, on May 27th, Tesla cut the price of the Model 3 and the X and the S. The S and X were cut by $5,000. The Model 3 was cut by $2,000. Then on October 13th, Tesla cut the price of the Model S again by $3,000 after the previous cut in 2020. And then they cut the Model S again just 6 days later, another $2,500, while also having cut the Model 3 by $2,000. So Tesla has had this history of basically declining intro prices sort of for the vehicles. And as somebody who bought the car 3 years ago, I'm like, dang, I could have saved some money. But then again, I'm happy I had the car for 3 years because the car is what inspired me to buy lots of Tesla stock. So I have to be grateful for that. Now, at the same time, Tesla shows us that their prices are going down, which is right. The analyst is right. Tesla's car prices are going down, and they keep cutting prices to be more competitive, whether it's because we got Lucid Air releasing a car that potentially has more battery range than Tesla's Model S, and so Tesla then decides, let's just cut the price of the Model 3 to continue to be competitive, even though the Lucid Air isn't even selling yet. Tesla has their prices coming down. And so this got me thinking, okay, well, let's go ahead and pull up Tesla's vehicular margin. Let's see what this dude is looking at and see if he's got any reason to be, complaining. So what I did is I pulled up the investor presentation over at Tesla, and this is our favorite line right here. This is called automotive gross margin right here. And this gives us a little bit of an idea of what Tesla's margin has been. So we had a price cut about maybe 2/3 of the way through quarter 2 at the end of May. And then we had another price cut in quarter 4, which obviously we don't have charted here yet, but hey, the analyst is kind of right. I mean, look at this. The margin went from 22.8%, a little bit of a dip at the end of 19, to up in quarter 1, or fractionally down in quarter 2, and then up again in quarter 3. Hey, what's quarter 4 going to look like? Quarter 4 could look interesting. So why is Tesla's margin doing so well while they're cutting prices, and we've got another couple price cuts to introduce into the margin here as well? Well, some analysts like to say it has to do because Tesla includes, and this is sort of what the bears like to say, it's because Tesla includes these right here. These are Tesla's regulatory credits, basically carbon offset credits. And Tesla gets a lot of money for those, and Tesla includes those credits into their automotive margin. So to separate this out, I made a little spreadsheet over here, and here we go. Look at Tesla's margin now, and I kind of wonder if the analyst who's bagging on Tesla didn't do this. I'll hide myself for a second, but look at this. This is the listed margin that we have on the report from Tesla. But if we actually look at their margin without these credits, if I take out all of these credits right here and then divide by their revenues, these are the margins I get. So you can actually see these declines over here, especially in quarter 2, right here. In quarter 1, we're down to 18.6% margin, right sort of in line with some of the new 2020 pricing that we saw. Then we have the price cuts in quarter 2, but we also have COVID that really affected margins, and we didn't start seeing margin go up again into that 20s range, 22 to 23% until quarter 3 in 2020. So, when we take out the credits, yeah, I mean, there have been some margin hits. So I don't know if this analyst is just trying to find a reason to call Tesla Bernie Madoff, basically, by making fun of the top line number without breaking apart the credits and realizing, no, margin did take a hit here. Could be potentially because of COVID, but also because of the price changes. Could be both of those. Big question is going to be, hey, what's quarter 4 2020 going to look like? And so then this kind of just gets me wondering, like, is this just another person who needs some Tesla shorts sent to him? In fact, Elon Musk had a hilarious rebuttal to a short seller in the past. This was from the end of 2019. Take a look at this. He sends this long tweet to David Einhorn, which Ein is one in German. And so that would be like one horn. And Elon Musk picks up on that and goes, "Dear Mr. Unicorn," fabulous name, by the way, because it's one horn. Anyway, we read your letter, blah, 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 blah. And basically, Elon Musk here is slamming the guy, saying, hey, look, we get it. You have to, slam Tesla because you're trying to save face with your investors for all the losses you've gained because you've been shorting Tesla. And Elon ends that with, "Finally, please allow us to send you a small gift of short shorts." I mean, it's brilliant. Elon's like the greatest troll ever. Of course, David Einhorn jumps over here and goes, hey, it's not us who has an entire website dedicated to all the untruths we've told. And I've never even heard of this website, but apparently it exists, elonmusk.today, and they just kind of list some old quotes from Elon Musk. And there's some more complaining here from David, although since this is from 2019, honestly, I don't think we have to pay too much attention to David Einhorn's ideas. Hopefully, he got out of his short positions. But it does always leave me wondering, do we have to be concerned about Tesla's margins? I mean, ultimately, we're investing in Tesla, and the last thing we want to do is have blind faith. When a market starts getting to the point where everybody's going, you can't go wrong, you can't go wrong, you can't go wrong, that's usually a time to be a little nervous. And so I'm always trying to understand what is the worst case? What happens if things just go in the pooper? How bad is margin going to impact our stock? And so what I want to do is I'm just going to go ahead and pull up our handy dandy Tesla spreadsheet here. Now, my vehicles delivered in 2022 here, this 2.5 million, that's probably too high. If we can actually get to 2 million, I think that would be a record in 2022. Honestly, at this point, with how slow things are ramping up, this might not happen. I think Tesla is estimated to deliver around 800,000 to 900,000 vehicles in 2021. Then we'll have 2 new facilities open at the end of 2021. We'll have Berlin and Austin. Maybe those can crank, a couple hundred units each on top of the others. So honestly, we could potentially be all the way down at like 1.2, 1.4 million vehicles produced for 2022. That's going to create some issues. But we're not going to speculate here right now on vehicles delivered, because the lower the vehicles delivered is, the bigger the PE ratio is that the market's going to value Tesla at anyway. So for right now, I just want to look at the impact of margin. Keep in mind too, for right now, we're not going to include any kind of insurance, semis, or robo-taxis, and we're going to include full self-driving in Tesla's revenue per vehicle. So by 2022, honestly, Tesla's revenue per vehicle will probably still be a little bit higher, but I think in the long run, we'll see Tesla's revenue per vehicle, including the full self-driving, especially when that $25,000 car comes out, it'll probably be somewhere around $40,000 per vehicle. But more important right now is just trying to understand the impact of margin. So if Tesla delivers 2 million vehicles in 2022, a fair earnings based on 50 times earnings, or a fair stock price based on 50 times earnings, would only be about 701, which honestly is kind of where we are right now. Tesla's not going to be valued at 50 times earnings in 2020. I think it's going to be worth at least 100 times earnings. So, if we actually get to 2 million vehicles, we could see, some nice stock price growth by 2022. If this ends up being closer to 1.4, that's obviously going to hurt a little bit, but the stock will still have growth in it. It's still a $1,000 stock by 2022, which means if you bought it today at $710, even at 1.4 million vehicles delivered at the end of 2022, you're still generating, a solid return here. And this is a rate over 2 years. Let's just change that there. There we go. Your rate of return over 2 years in this example is still 20% investing in Tesla. Again, assuming the market values Tesla at 100 times earnings, which is only fair if Tesla continues to be on this mega high growth trajectory. In order for a company to be valued at 100 times earnings, it has to be like early in the S curve of sort of exponential growth. If you're in the flattening curve, you don't value Microsoft or Apple at these numbers because they're kind of at that flat part of the curve. They're still going up, but they're not going up exponentially in growth, right? So you value those companies at like 30 or 40 times earnings, which if you did that to Tesla, this is where you get the natural, oh my God, Tesla's way overvalued. Tesla's worth $362 a share. Well, that's what happens when you use a low price to earnings ratio. But for a company with the trajectory that Tesla has, we generally use a larger PE ratio. And this makes sense. Like Amazon's a 90 times earnings, and a lot of the SaaS companies, which I know Tesla's not a SaaS company, but they sell for almost, some of them infinite earnings. Like you got DocuSign that sells for infinite times earnings, and Snowflake. And you've got Square that's more highly valued, Lemonade. I mean, you got a lot of companies that are very expensive right now. Relative to the growth, Tesla's a pretty dang good bet. But what I want to show here is the danger of margin. So in this, I'm assuming that by 2026, we have a 26% margin. Consider this, I put expense margin here. That's the opposite of what I told you earlier. So I don't want to confuse you. But this assumes a 26% profit margin, gross profit margin on sales, right? Because it's just 1 minus this number here. So 26% should be reasonable, whether it's with credits or without, because Elon Musk has a goal of getting to 30% margin. And we're going to go conservative here and go with 26%. These are the numbers we got here. So same thing, $1,000 even at 100 times earnings with just 1.4 million vehicles delivered, and this revenue per vehicle being relatively low. That assumes revenue per vehicle is going to plummet like 10 grand over the next couple years. It might not. If I prop this back up to 50 grand per vehicle, you can see the share price jumps about $1,200 or to $1,200. So a couple $100. But the big thing I want to show you is the change that margin does to Tesla. And this is why margin is so important. Margin is considered the Achilles heel of Tesla. This is why analysts, when they attack Tesla, they always attack vehicular margin. Makes sense. For Tesla to make a lot of money in the future, it's all about that margin. So if we go ahead and just leave this at $12.50 per share price, that doesn't matter so much. What we care about is the delta, the change in price. Let's go ahead and plummet margin to 20%, which is bad. I mean, NIO is going to beat Tesla at 20%. They're not there yet. They're at like 15%. But they're going to beat Tesla if Tesla gets stuck at a 20% margin. But let's do it. Let's see what happens to the share price. Okay, so now we have an expense ratio of 80% or profit of 20%. So let me just make sure. Yep, that should have calculated. Okay, perfect. Put that back in here. Let's see how the share price changed. Yeah, you can see the share price basically sells off here about $350. That's a lot. Like margin has a big impact. And then if I put this back down to revenue per vehicle of 40, yeah, you could definitely see the share price almost doesn't move if we have a revenue per vehicle of 40 at the end of 22, 1.4 million vehicles produced, and a profit margin of 20% here. Big kind of damage to the share price. We go back to that 74%, that 26% profit margin, we get that share price back up. So Tesla is very sensitive, almost more sensitive to margin than it is revenue per vehicle, or even revenue from like semi-trucks or other sources, which semi-trucks I anticipate will be relatively low revenue for the time being. Insurance, we could really tentatively just include this in services, which is where Tesla includes it anyway right now, so we don't have to break this out. We're not really cheating Tesla by not putting these things in yet. And even though we might see robo-taxis, in 2021, maybe, it's way too early to see how Tesla's going to monetize robo-taxis. So you have to be really careful there. Like, I could be really rosy with these projections. Like, if I wanted to just be ridiculous with my projections, I could load in some major numbers here. We could go nuts on margin, go to Elon's optimistic POV. We could go to a lower effective tax rate. I mean, there's so many things you can do to manipulate these sheets. But I like to be conservative because ultimately I'm throwing my money into this thing too. So got to be a little conservative. But this explains why is it that analysts love to bag on Tesla margin? So now this is where we get to the interesting phase of, okay, well, what was Barron's conclusion? And this is one of the reasons that I like my Barron subscription. And I've got a lot of subscriptions. I mean, I got the Bloomberg Terminal, the Wall Street Journal, the New York Times, the CNBC subscription, the Prime Premium subscription or whatever, Yahoo, I like Bloomberg. I got all of them, okay? Out of all of them, I have to say, Barron's, folks, this is a good one, okay? And I don't always read them in paper, but I do get the paper version. But they're good. They're really good. And so they chimed in on this. And they said something that I thought was really interesting. They chimed in and said that one of the reasons, or one of the things that actually helps Tesla's profitability a lot, and this is something for investors to consider when they compare Tesla to other sort of more traditional dealers, or manufacturers, I should say, is that there are no dealers that are third party to compensate like a traditional car dealer. Toyota has to compensate dealerships and advertise on the behalf of dealerships. Tesla doesn't do that. Tesla doesn't advertise. They're more of a meme that self-advertises, which is like the best form of advertising you could ask for. And there are no dealers to pay, referrals to, or kickbacks to, or credits to, whatever. None of that. Incentive pricing, none of that. Tesla is so vertically integrated, and that's one of the reasons I really love Tesla. And now, look, is Tesla ever going to have the margin of like a software as a service company? No, of course not. They're manufacturing cars after all. But if anybody can get the margin down, it's going to be a vertically integrated company like Tesla, where their priority is, and I love this quote, hopefully it's not too redundant, but Elon goes, we make the machine that makes the machine to make the machine. AKA, they figure out how to put together the device that creates the device that can actually put the cars together in the factories. And that's one of the things Tesla says that actually helps keep a moat around their manufacturing margin, is because nobody else is trying to create these machines that can, bring down Tesla's pressing processes to taking, something that once had 70 parts and bringing it down to 2 parts, or maybe even 1 part. And that's something very unique at Tesla. NIO, for example, doesn't have that because, and maybe they will in the future, but, they partner with JAC, which is half CCP owned and half Volkswagen owned. And so they're going to have different incentives as they're also manufacturing other cars. They're not stamping only Model 3s or only Cybertrucks. So it'll be fascinating to see how this evolves. But Barron's had a really good argument here. Barron's then also said, hey, another thing to keep an eye on is, and this was from some of the criticism from these analysts, was that Tesla has been cutting back on their warranty accrual, which warranty accrual is, think about it this way. If you sell a product, like let's say I sell mugs and I sell 10,000 of these, and I promise everybody that there's a money-back warranty, or maybe not a money-back warranty because that's like a money-back guarantee, but a warranty that if it cracks because you microwave it, I'll replace it for you. So I might put aside, I don't know, 2% of all my sales for warranty claims, because like who's going to do a warranty? I don't know, on a coffee mug. It's not even worth the time to really do that, right? But anyway, so let's say say I sell 10,000 mugs for $5 a piece, that's $50,000, and I set aside 2%, that's $1,000 that I'm setting aside as a potential warranty expense. Well, if I go in and say, hey, you know what, guys? Today we're changing the accounting measures. We're just gonna set aside 1%. Oh, well now we only have to set aside $500 in warranty accruals, which means we just made an extra $500 of profit. That's where analysts come in and they're like, you're doing some fancy accounting here, aren't you? Now, this gets really this could get really granular and boring and detailed. So I'm not gonna go into this any further, other than telling us what Barron's bottom line is, which I respect Barron's a lot. Barron said that Tesla's warranty assumptions are in line with the rest of the auto industry, and beyond that, this is me adding here, many of us believe, at least those of us who love Tesla, that Tesla might actually potentially have fewer warranty claims in the future given how few parts their electric systems have. Now, keep in mind, that could also be dangerous because Tesla does also warranty the batteries, and Tesla's quality, customer, quality control, QC, doesn't have the reputation for being the best. So is it possible there could be more warranty claims at Tesla? I mean, they get sued for warranty claims, right? Recalls, I don't know, maybe. Why are they cutting the warranty accrual while at the same time all those things are happening? So this is where, when I hear somebody with a different perspective, I like to look into it as much as I can. And so this is something that here at the beginning of January, as Tesla investors, you're definitely going to want to pay attention to is, I personally don't give a crap about what the deliveries are. Every person's going to be, news outlets going to be clickbaiting Tesla's deliveries. Oh my gosh, it's over, $500,000 or 500,000 vehicles. Who cares? I don't care if honestly, I would prefer Tesla miss 500K for the year, go deliver 470 and blame COVID so the stock tanks and I can go buy more. What I care about is the margin. I don't care if you delivered 5,000 more cars than the target. It's just a psychological head trip. It's stupid. Elon cares because he knows it's important to the share price, and that's why he's, pitching, hey, if you get a car delivered in the last 3 days, we'll give you full, free self-driving as a trial for a year, which now costs $10,000, and they'll give it to you for free for a year. There was even and I don't know if this is true, but I saw this somewhere that Tesla was trying to give someone delivery of their car at 1 a.m., and they were complaining about how that's not cool, Tesla, and I'm thinking to myself, dude, if you're excited about your Tesla, take the damn car at 1 a.m. They're trying to deliver before the end of the year, and they're giving you 1 year of free self-driving. What are you complaining about? Set an alarm clock if you're gonna go take your nap at 10 p.m. and just wake up at 1 a.m. again. Or do what I do when I get my pizza and go, leave it at the door. It's not that hard. Anywho, I don't know, maybe I'm different, but keep this in mind. Tesla's critics are going to attack what is seen as Tesla's Achilles heel. If margins falter, the stock will falter. The deliveries, not a long run issue. Whether they hit or miss, yeah, is it probably gonna shift the stock price? Maybe, don't care, it's too much though. Margin, bigger issue. But we're not going to hear about margin until Tesla's next earnings call, which I don't believe is until February, which unfortunately, as much as I'd love to present that, all we're going to get here is, hey, congratulations, we delivered this many cars. We'll get something like that, and then we'll be sitting around for the next earnings call. Yeah, we don't even have a date right now for the next earnings call, so my guess it'll be either late January or early Feb. We'll see. But anyway, that's what we've got for now. Thank you so much for watching. If you liked it, consider subscribing. Check out the courses down below if you like my perspective. Get yourself some tax write-offs. And folks, we'll see you in the next video.